Welcome to Part 4 of the Work Compensation Consideration for Interstate Motor Carriers. If you have questions during the presentation, please type them in the chat window. We will answer these questions as time allows during the presentation, or if not, we'll email you the answers to the questions after the presentation is over. And if the questions are of general nature and beneficial to all, we will copy your question and the answers and share them to everybody. Clearly, we'll take individuals' names off, but it's a way that we can share information because others would have the same questions that you do. If we have problems during the presentations, either audio or other, please type in the chat window. If you lose a presentation completely, call 800-741-4084, which is our office, and let Beth know that we have a problem. We'll attempt to correct the problem as soon as possible. Providing work compensation coverage is complicated because of multi-state exposures. Therefore, by the definition of a motor carrier who is an interstate motor carrier, they have multi-state exposure. So providing work comp coverage to motor carriers is more difficult than most other type risk because of the multi-state exposure. The reason the multi-state exposure is so difficult is because each state has its own work comp laws. And when the employer, which is the motor carrier, has an employee, which is their drivers or workers in other states, then you have a situation where the employee has options of what state law to collect benefits under, and the employer needs to make sure that their work comp policy is set up so that those exposures or those claims made by the employee would be addressed under the policy. So what states may an injured worker claim benefits under? Most state laws give the injured worker 4 options: the state they were hired in, the state they were employed in, the state of injury, and the state of residence. Those are the 4 options. It's the options of the worker, the driver, the employee, not the employee. State they're hired in. I heard an advertisement the other day where Walmart is hiring drivers in Oklahoma. Come by in Tulsa, we'll hire you. But if that driver then is assigned to a location in Houston, Texas, then that's the second possible place. If they are driving through Arkansas, that's the third, but they could live in Kansas, which would be the 4th option. Those are the options that the employee would have, and the employer cannot direct or has no options there. So the concern with setting the policy up for the motor carrier is to make sure they have protection under the work comp policy for the employees making claims under the various state work comp laws where the employee might be able to claim. To do this, in setting the policy up, in the 3A section of the policy, you must list all states that the insured, the interstate motor carrier, has a place of employment. Smaller motor carriers, this is not that difficult to do in all cases, but in larger motor carriers with multi-terminals, or if they have driver forces hired from a large geographical area, it could be more difficult. So you would have to know where there's a terminal, where they have a recruiting office, and more important, what state the drivers live in. Because for a truckload carrier who is interstate commerce, most of the time that truckload carrier allows the driver, the employee, the person who is driving the vehicle of the motor carrier home. Then their house becomes a place, or their state they live in becomes a place of employment. So therefore that state must be listed in 3A. You do not have to be you do have to be an admitted insurance company to be listed in 3A. So if you buy your insureds are pursuing insurance coverage for regional carriers or from state funds or in some cases assigned risk, you must be sure that those carriers can list the states that you need in 3A. If not, you might have to end up writing more than one policy to achieve the objective of making sure that there's wherever the insured has a place of employment is listed in 3A. The 3C addresses places that the driver might be where there is not a place of employment. It's not where their terminal is. It's not where they were recruited. It's not where they live. It's just the states they drive through. Those would be listed in 3C. Recommended wording in the other insurance provision is all states beside monopolistic or states listed in 3A. The insurance carrier does not have to be admitted insurance company in the states to list in 3C. But because the employee has options, the driver has options of 4 places, then you want to make sure that the work comp coverage provided to the motor carrier would address any claim under any state law the employee would attempt to make a claim under. This would also then generate premium. And here again, you must determine what state the premium will be allocated, the payroll will be allocated to develop the premium. The auditor manual says gives the 3 options to place driver payroll. The place they have a terminal. However, in the auditor's manual, the definition of terminal says a place where the driver regularly goes to load and unload. For a truckload carrier, they probably do not have a, quote, terminal, unquote, that meets this definition. Truckload carriers would not. LTL, less than truckload carriers would. Private carriers probably would. So that would be a situation that you would have to address. The second place payroll could be allocated, where the place the majority of the miles the driver generates, meaning what state are they spend the most of their time in. Here, the IFTA reports, the International Fuel Tax Agreement reports, could be a means to determine what state the payroll of the driver should be allocated in. But more important, the last option, which is the easiest one for most everybody, is the driver's state of residence. Most of us in truckload carriers insurance understand this and know what these states are because we ask for the driver's license numbers of all drivers, and that shows what state those licenses were issued under. So they need to be in 3A. You need to clear this up at policy inception and make sure you're assured, the motor carrier, and the insurance company all agree on what state the the remuneration to the driver will be allocated to. The second concern with premium is owner-operators, independent contractors. These are people who drive their own truck and they lease those trucks to the motor carrier to operate it on the motor carrier's behalf. These workers, these independent contractors, these owner-operators, if they get hurt, would they want to be paid for the loss of wages, for the medical costs, and anything else they can get an attorney to claim for? Or if they're killed, would their family member want dollars for their death? The answer to that question uniformly is yes. That's human nature. I don't care what contract they sign going in. When they get hurt, that contract becomes unimportant as far as they're concerned, and they'll attempt to make a claim depending on which, either as an employee or independent contractor, depending on what benefits them. So let's talk about this claim. What coverage, meaning work comp, auto liability, or general liability, that the insured has purchased that would address this injury? It depends on, was the worker an employee or not? Independent contractor, employee, big question. So let's look at this. Employee, they get hurt. All they have to tell the representative of the employer is, I was hurt. The work comp carrier of the employer would then start the claim process and pay the benefits due. They would not have to prove negligence. Whatever happened would happen. The worker was an employee, can seek no additional benefits. It's the sole remedy and the tort immunity, meaning they cannot sue for any other benefits. They have to collect the benefits the state work comp law allows. The worker is working for the insured, and they do so as a independent contractor. The worker gets hurt while performing duties for the business, the interstate for-hire motor carrier. Would they still want someone to pay for their injuries? Again, absolutely, that's human nature. Depending on how they get hurt, what would be paid and by what policy? This will determine that. They could claim under tort, meaning I was injured by the negligence of the motor carrier I'm leased to. Or they could claim under work comp, saying, I was an employee, therefore I want my benefits as an employee under the Work Comp Act. So let's talk about this. Again, the worker would get injured, and now they get to determine what benefits and what they will claim, and as a independent contractor or employee. Remember, this is determined by the employee, the worker, the independent contractor. Any kind of contract they sign doesn't mean at time of injury they will not attempt to modify that to collect their benefits. Again, that's human nature. The worker hurts him or herself, causing an auto accident. They run off the road. They then would want to be established as an employee and collect work comp benefits because now they hurt themselves. And in work comp, since there is a sole remedy and it's a no fault, then they would try to become an employee. And I'm sure all of you know the questions of the classifications and employees. Even if they have own coverage later, the OC Act policy, they could still claim to do that. Or the worker hurts because of falling off the business, the motor carriers they are working for, they're leased to. They're hurt by the business fault, by the negligence of the business. They fall off the loading dock because of a failed guardrail. Then they do not want to be employed. They would want to sue damages as the public under tort. Why? Because they can collect more money. They can collect pain and suffering. They can collect future income. There's a lot of things that could be collected under tort that would be more beneficial to the injured worker. So they have that option. The motor carrier requires owner-operators to have an OC Act policy. That Act policy is not work comp. As we went through the third hour and explained this in depth, the OC Act policy is not work comp. It does not extend tort immunity to the motor carrier, meaning that the independent contractor, even with OC Act policy, even with contingency comp, can still sue under tort. The policy also would have defined benefits. Limits, most of the ones that we deal with have $1 million limit. Time, a lot of them say the claim has to be paid, the lost wages and or medical would be for 2 years, a period of time, and so the coverage could run out. The OC Act policy is a personal life and health product purchased by an individual to pay him or her for their own injuries, medical and lost wages caused by an occupational injury. It's not purchased by the motor carrier. The motor carrier gets no benefit out of it other than, hopefully, because there is payment made, the owner-operator independent contractor will not seek a lawyer to sue under tort or under the work comp of the motor carrier. OC Act, individual policy. So if they have other workers, OC Act will not protect the independent contractor from their obligation under state work comp laws or under tort. What we're talking about here is if they have a mechanic or a second driver or a spare driver or the second vehicle. An OC Act policy, even on this other individual, will not relieve the independent contractor from the employer status because they have a worker here. Even with contingency comp, they would need a true work comp policy. No protection from tort with OC Act, even with contingency comp, or even if standard work comp for motor carriers, independent contractor at least two they work for. In other words, if they get injured, they can collect OC Act. They could even collect on their own work comp policy and still sue the motor carrier if the motor carrier is negligent in causing the injuries to the worker. In other words, tort immunity is not extended. One of the problems with this is the federal definition of employee. Under the federal definition of employee, an employee means any operator of any commercial vehicle, period. Any operator, any commercial vehicle, period. Meaning if that person is operating the commercial auto that is owned by, operated by, leased to, used by any form of manner, the vehicle, and basically the way you sum it up, if your insured has a DOT number on the side of that vehicle, then it's being used by that driver to benefit the motor carrier whose DOT number is on the side. Therefore, in a federal definition, they're an employee. Their employer is the motor carrier who is allowing this to be done. So that's the problem here. This is for safety purposes. This is so the motor carrier can't deny oversight and control of the operation, because if I have a DOT number or your insurers have a DOT number and they operate the vehicle on the highway, they're absolutely liable, with some exceptions and a tort, under negligence, the definition negligent, for the use of those vehicles if they get hurt by the public, no matter who drives it. They can't come and say, whoa, I'm not responsible for that because that person was independent. That just doesn't work in the interstate for-hire work comp arena. So this is the problem you get to overcome this. This is why you need to be careful when your insurer tells you they have independent contractors, owner-operators. They're not an employee. And the test that most lawyers we deal with suggest the independent contractor must own or have a legitimate lease of that vehicle. Lease purchase or installment purchase will work, but it cannot be leased from the motor carrier. It can be an affiliate leasing company owned by the motor carrier, but it must be in a separate legal entity. The terms must be similar to customary available in the retail transaction, meaning down payments, interest, etc. The problem is there's no similar transactions because of some credit issues. How many owner-operators have the cash and or the credit ready to justify the finances of a $150,000 unit? But more important than that, motor carriers must form the separate entity. They must plan carefully for the tax consequences. And lastly, the independent contractor owner-operator leases the vehicle from this leasing company, even owned by the motor carrier. Then they have to lease that vehicle to a motor carrier. It can be the motor carrier who owns a leasing company, but the lease has to allow the motor carrier, the owner-operator, to lease it to another motor carrier. That's the portability. So it must be owned by or leased by the owner-operator. The lease must be for the unit with no requirement of who they can lease that vehicle to. Then they can lease the vehicle to the motor carrier who arranged for this financial arrangement or to any other motor carrier. If this is not available, then most cases they will not be deemed an independent contractor. They will be deemed an employee. So providing work comp coverage to the motor carrier, everyone needs to view the classification of the worker the same and agree on the classification. If not, a problem. And even if it could be a concern, meaning that there could be a disagreement either by the employee or the auditor, the worker or the auditor. Rate for each classification times hundreds of remuneration less adjustment. This is what the premium is based on. The rate set by the insurance company. The classification depends on what the worker does, and then they take that times the rate times the pay, hundreds of remuneration, and there could be some adjustment. This is what we're going to talk about in this fourth hour to start with. Remuneration. What is not remuneration is overtime. Interstate truckers are not subject to overtime, so we're not have to worry about overtime, which typical employment does. Per diem. This is an allowance, but it's only allowance for $30 a day for the driver being away from home. And that can be separate rated from the pay to the driver. And that can be 1099 and or set aside, and that does not constitute remuneration under the Work Comp Acts of most states. Be very careful about how much the per diem can be. It would also depend on states. The typical NCCI is $30 a day. States have fixed rates like Florida, so all work comp providers in that state use the same rate for the same classification. However, the majority of the states are something called a loss cost state. In that case, the carrier adds factors to the loss cost approved factors by the state. So therefore, the rates can vary not only by the work comp carrier, but in some cases the work comp carrier has 2 or 3 different companies filed, so it would depend on what company your insurance carrier issues the policy under. So they could have different rates per classification. So we need to be concerned about the rate and how that's established and what is remuneration. Classification, state that will be applied to at audit time. You need to clear this up at policy issuance. Insurance concern. Is premium reflected the benefits that might have to be paid when the worker is injured? For example, and this is one that's overused, but the way I understand it, and talking to work comp carriers and talking to insureds, there's a great deal difference in premium between Indiana and Illinois. And let's say we have a motor carrier who has an office, who has a place of employment in Indiana, but they spend the majority of their time, their drivers spend the majority of their time in Illinois. Some of their drivers live in Illinois. That work comp carrier would not be comfortable charging the Indiana rates for that Illinois exposure. But you need to discuss this up front. If the opposite was true, where they were domiciled in Illinois, who has a higher rate, even though they spend most of the time in Indiana, that work comp carrier might be comfortable using the Illinois rate, even though most of the exposure would be in another state than Illinois. These are things you need to work out with your insured and your insurer's carrier when you set the policy up. And what states could there be injured? Again, place of employment or place where they'll be. IFTAs will tell us that, or the states they live in will tell us that. And again, we need to be comfortable that we're getting enough dollars for the injuries possible, and that's what the auditor will do. But again, this needs to be cleared up at policy issuance. You don't want to leave many options for the auditor to adjust payroll by states or even classifications. Unfortunately, and this is again human nature, the motor carrier, the insured, wants the payroll to be assigned to the state with a lower rate. Duh, we all want that to happen. This is what they'll tell us. A lot of agents err in that way because they don't think through it. And I'm always surprised me why a work comp carrier, insurance agent, would want to charge the lower rates if that's not legitimate. Why? They get commission on that. But they need to work through this. Even though that's the desire of the insured, the motor carrier, you want to make sure that the work comp carrier going in understands that. The insured also wants payroll assigned to the lower classification. The classification is a job description. NCCI designed to classify the business, not the duties of each business. In other words, they look at the overall business. You don't divide it up. The Scopes Manual, which is the Bible for classification by NCCI. Some states have their own manual, but basically the manual of all the independent rating states, like North Carolina, is based on NCCI. The over-the-road truck classification is 7219. Some states have a breakout for local versus the long haul, but for the sake of this discussion, long haul. Most states will allow clerical and sales to be broken out, but most states will not allow mechanics and yard workers to be broken out. So therefore, the mechanic who works on the truck or the yard people who spot trailers, work on that, would all fall in the over-the-road motor carrier classification. This is how it's done. If they have a warehouse facility, it would be separately rated. So what you have to worry about sitting there, here is a typical truckload terminal. They have drivers, they have dispatcher clerical, they could have sales reps on the highway, they could have mechanic, and they could have someone working in the yard to wash the tractor trailers, to clean them out, or to swap the trailers for maintenance purposes, those things. You need to make sure that how these workers are going to be classified. Based on the scope manuals in most states that I'm aware of, all those workers except clerical and sales will be classified under the prevailing classification, which is long haul over-the-road truck driver, which is 7219, which is in most cases a higher rate than what the yard person would be or the mechanics would be if it was a garage operation by itself. You need to make sure that the insured, the insurance carrier, and you understands this, because the insured will attempt, and they won't understand all this concept, that all the operations under one classifications instead of individually. They'll say, well, the mechanic can't get hurt as bad as a truck driver. They're right. But because the way the rates are promulgated by the state, they collect the exposure and the premium developed by the pay to these workers collectively. So the mechanic exposure for a long-haul trucker would be factored into the rate classification. So therefore, it's adjusted that way. It's just the way it works. The bottom line here is you want to make sure that all the workers that your insured has, and the larger the risk, the more important this is, because the larger the risk will have these other operations. Smaller trucker, 4 or 5 units, 6 units, might not have a mechanic, might not have yard people, might not even have a terminal where trucks can come to for purposes of parking or checking or cleaning them. They would then not have this problem. But once we start adding mechanics, yard people, this is when the insurers don't understand how the classification works. Again, check with the scope manual, check with your individual insurance carriers how they want to classify each worker. So therefore, you need to ask, who are your workers, how much do they get paid, and what do they do? You need to communicate this clearly with the work comp carrier and make sure that they all agree on these operations and what rate, what classification they will be assigned to as a function that will determine the rate. Clear it up front. Make sure the insured and the insurer agrees this. You want to get it in writing if at all possible. What the best way you would do if you send during the application and you have it broken out differently than that, you want to make sure they accept this going in. This is a big problem because later, if it's not, the auditors there'll be some surprises in audit, and that's something you do not want, because you don't want to rely on the audit to make these changes. You need to prepare your insured for an audit. The worst thing that you can have your insured do is when an auditor walks into the door, send them to the payroll department or to the controller or to the bookkeeper, or more important, to the off-site bookkeeper. They need to understand how these things work. You then also need to prepare them for this audit. What you got to explain to them is that what the premium that's shown on the work comp policy going in is an estimate premium. The actual premium will be determined based on what your payroll is during the policy term. So my suggestion is take the down payment and all payments made to insurance carrier and have an account called prepaid insurance. All those items get posted to prepaid insurance, and then develop a separate worksheet for your insured that they fill out monthly, or you could have it quarterly, depending how large they are, that takes the pay that they have paid to their employees times the rate. And again, you want to make the rate be the exact rate that's going to be collected. Any adjustments later, we're talking about premium size, experience mod, etc., would be in that rate per each classification, meaning clerical, sales, and drivers. And then they can do this worksheet, and that on a monthly basis will be then put in the prepaid expenses. And so any given time, you can look at this prepaid insurance account, and if there's a credit in it, meaning they have paid more in than what has actually been used, then at audit time, you know they're going to credit back. If they have an additional amount due, a debit larger amount, then you know at audit time they're going to get a premium adjustment that will cause them to pay more money. This you need to explain to them. The problem I have found is that insureds have a problem paying additional premium, but they have less of a problem if they can anticipate what they owe. This allows them to anticipate this. You need to do this for all your insureds. This helps you, helps the auditor, helps the insurance company take care of any problems at audit time. You also need to tell the insured what the auditor will need, so they prepare it. You want the state tax reports, the unemployment tax reports. What that'll show is each driver's, each worker's, each clerical's name, and how much they get paid through the year, and what is paid. This is the payroll. They also would want a copy of their balance sheet. This will show who they 1099 independent contractor. And if they 1099 everybody, you need to be prepared to get a certificate of insurance for these independent contractors. and you need to verify this. In the case of owner-operators, independent contractors, here in this case we're talking about more mechanics, outside work that's been done, could be work on the maintenance, the building, etc. But as far as independent contractors go, if the independent contractor has even OCAT with contingency comp, you have to find out, will that work comp carrier accept that in lieu of work comp? You need to be careful with this because a lot of times they don't. I'm in a situation right now in Florida where there's a motor carrier who was through the assigned risk who had 4 locations. The independent contractors had had OCAT with contingency comp. However, the agent did not clear that up at policy inception, and the work comp carrier says, we're not going to accept that OCAT with contingency comp in lieu of work comp for the independent contractor. So everything the independent contractor got paid. Again, they use the third rule, which only goes to the pay, and that's typical when you have the independent contractors covered under the work comp of the motor carrier. Only a third of what is paid the independent contractor will be considered payment for the driver under work comp. And so they would charge that additional premium. You don't want this to come back and bite you. If your insureds are using independent contractors, you want to make sure, and they have OCAT. Some OCAT carriers or work comp carriers will accept that, particularly if the contingency comp is statutory or unlimited. That will protect them. You don't want any surprises later. So you not only have to worry about who they 1099, have to worry about the classification, but also have to worry about, will your work comp carrier accept OCAT with contingency comp in lieu of the independent contractor having their own work comp policy? That I cannot give you an answer to that because, again, it depends on the motor carrier, or excuse me, the work comp carrier individually. I'm just alerting you to the problem that this could happen, and you don't want any surprises. So, at audit time, you want to make sure the assignment of payroll is as a personal class as you and the underwriter, as the agent and the insured agreed to. You want to make sure the MCIEF state rules do not allow insurers to add classifications in audit unless there's a change in operation or application, or the application is misrepresented. What this slide, I added this, is you don't want to ever put an if any classification on a work comp policy, because if the classification is on the policy, then the auditor has opportunity to adjust those within the payroll within those classifications. If there are not the classifications there, after the policy has been issued for, in most states, 60 days, a few say 90 days, then they cannot, and they then can adjust it back to policy inception. After that period of time, they would then find it, and if it's found during the policy term, do a pro rata adjustment. But once the policy is over, they cannot move payroll into classifications that are not on the policy unless the insurer has started a new operation. That's why you need to clear this up front. So make sure there's no misunderstanding of this, and don't put, if any, on the from a classification standpoint. Now, from an insurance carrier standpoint, if they charge a new operation that you did not know about, then clearly you can add that to the policy once the auditor is there. And again, that could be a new driver hired in a new state. That would be something that would be adjustable there. But you want to clear this up front. The worst thing you can do is have surprises at audit time, because when those happens, everybody has a disagreement. You have a collection problem. It spends more time than it's worth trying to find all this stuff out. So decide it up front. If the auditor is at the insurer's location and attempts to change classifications, state, or remuneration, or the classification owner-operators pays exposure, don't let the insured sign the audit worksheet. Don't let them accept that. The auditor has to leave a worksheet with the insured that says, here's what they found. Will you please sign that? If there's a disagreement in these areas, you do not want them to sign that. You want to stop right now and say, we do not agree with that. You want to do this before a bill is generated. If it's accepted and it goes to the insurance carrier, then an additional premium is going to be developed, and that insurance carrier is going to seek that and look at collections or try to collect it. You want to stop that whenever possible. So you want to say we can test the cost. So if the bill for premium is sent and the auditor does not reflect the agreed upon exposure, you need to send a letter, have the insured send a letter to the insurance carrier that says you are challenging the audit. Then start the process through the Department of Insurance. You don't start the court system yet. The Department of Insurance determines the proper classifications, and every state has a remedy to determine any dispute in classifications and premium. You want to start that process. The collection of the audit billing then is suspended until the audit results challenge has been reconciled. You need to be proactive here. So what we're saying is make sure everyone agrees on classification, including the workers and the states, that prepare the insurer to provide the information to the auditor in a way that auditor can accumulate it and put it into their system. If there's a disagreement as to the owner-operator's classification, the classification of the workers, or the state, you do not want to have that audit finished. You want to contest it right there that day before a bill is generated. And in that case, you want, in contestant, you want to go to the Department of Insurance and have it reconciled. You do not want to create a bill and collect a collection action. And this is to protect everybody. But the key part here is if you as a retail agent, and if you're listening to me as a retail agent, it's up to you to clear this stuff up front. You don't want any misunderstanding between the work comp carrier you have chosen to write this insurance comp and the insured to understand how all this is set up to make sure the policy is set up properly to cover their exposures in whatever state they have, but also make sure that the premium development and will be in the states and the classifications that everybody agrees to. So here's the cost consideration. The worker classification is the job in the state. Remuneration, pay, overtime, benefits for them, vacation pay. You need to explain that and have the insured keep separate accounting for things that are not remuneration, like overtime. Contributions to a retirement plan would be, but the contributions by the employee would not be. Per diems are not. Vacation times are. You want to straighten those out. Owner-operator independent contract. Exposure for the insured who are motor carriers. Truly independent. State laws might spell that out. The example I'm using right now for the Truckload Carriers Association, and one that I looked at in that audit I mentioned to you that's being that I'm involved in right now, where you have multi-states exposure and a large bill coming back because of not clarifying who's an owner-operator or not. Under Florida work comp law, as I read it, the work comp law says an independent contractor, quote, owner-operator, who is permanently leased to a interstate motor carrier is not the employee of that motor carrier. So therefore, those payment to that independent contractor would not be considered remuneration and would not be subject to audit. Whereas if, in this case, we had a location or drivers living in North Carolina, as I read the North Carolina current law, the North Carolina current law says that owner-operator is an employee. So you want to clear this thing up. Remember that OCAC, even contingency comp, is not work comp. You got to sort this out to make sure that everybody understands that exposure. If the independent contract is considered an employee, then you would want to use the third rule, which says what is being paid, because what is paid for is not only the driver's pay, but the lease of the vehicle, which includes maintenance and in some cases insurance, at least physical damage insurance, non-trucking insurance. And so what this manual says is take the gross amount that is paid to the independent contractor and take a third of that. And a third of what's paid to the independent contractor then becomes the pay to the driver that generates the work comp premium. Save time to have all parties agree at policy inceptions. Now the premium adjustment, if it's assigned risk. And a lot of times for smaller work comp, we have no choice but assign risk. That's the alternate ability to write coverage no matter how bad the risk is, how new the risk is, how lack of experience. The concept of assigned risk is that If work comp is mandated, as we said earlier, it's mandated in most states, Texas being not, Oklahoma not, a couple other states like Tennessee, this recently South Carolina I'm reading is talking about allowing them to opt out, but it's mandatory by the state. Therefore, the state cannot mandatory anyone to have certain insurance coverage unless they develop a mechanism so that no matter how bad they are, no matter how they don't meet underwriting standards, they can buy that needed coverage. And this is where you have the assigned risk set up in the for work comp. And the most assigned risk has a factor added to it. Florida, it is a factor that's almost doubles what the standard company rate would be. Again, Florida has a fixed rate, not an adjustable rate. So be careful as assigned risk. That's the most costly plan. Where you're going to have assigned risk and you're forced to be assigned risk, and setting this up is basically in three situations. The first one and the most important, your insured has no history. They're a new venture. And with no history, a lot of the work comp carriers do not want to write a risk unless you have 3 years worth of work comp insurance experience. So during those development of those history, the first 3 years, assigned risk might be the only option. They have a lot of bad losses. They have a high experience mod, which we'll talk about later. Then assigned risk might be the only opportunity. Or also you might have the rare case that we talked about earlier where you have a driver living in a state that your work comp carrier cannot list in 3A. You might have to go to that state and have that one driver's payroll listed in assigned risk for that state. It would not be all the drivers, just the drivers who live in that state, because the insurance carriers you're dealing with are not licensed in that state. If it's a volunteer market, then you'll have premium size discounts. That says once the premium is over, for example, $10,000, then any premium over that will be discounted by 9.4%. Or you can have mutual company discounts, which is about a third of the stock company discounts. So they'll have discounts based on size of premium. Then the insured can also get additional credits, again, depending on what states they're in. Some states have a safety credit if the insured has a safety program. Some other states have a drug-free workplace credit. Again, you need to prevail the opportunity of all these additional credits for the various motor carriers you have to maximize their credits that they're going to be given against the premium that's developed by the pay times the rate. But the most important part here is the experience modification. The experience modification is an adjustment based on the motor carrier's past work comp history and claims. And then there is an adjustment made on their payroll based on those past history. So what happens is they use the norm, the typical driver, the typical rate, the typical payroll, the typical motor carrier, the typical rate to find out with this discounts we talk here, with the credits we talk here, and that's what the premium is. Then they say, well, let's see if there's additional further modification that should be applied. If you have good experience in the past, then the factor will be less than that cost. If you have bad experience, it could end up with more than that cost. That's the big key here. That's the experience modification. So an insured can lessen their cost of work comp insurance by reducing their experience mod. Or if they have bad history, they could end up having more dollars paid because of experience mod. The mods are not always correct. So the agent and the insured must verify the information making up the mod is accurate. And the first place you do here is you look at two considerations. What is the premium charged during the policy term? Now you need to look at the premium not only based on the gross payroll and premium, but also by the classification, because the mods are factored based on how the worker was classified. There is more tolerance for claims for the higher classification, like drivers, than there would be for a clerical classification. So if we have a situation where the person who has the claim and it was misclassified and they really were a driver, yet they were under a clerical classification, that claim is going to affect the mod more than if they were classified, that loss was classified as a driver. Then what you need to look at is that the reporting period to the rating bureau starts 3 months after the policy ends. So the first period of time you would have is not during the policy term, the 3 months part. And the first year does not count, meaning the current year or the first year. So the most important time to verify the accuracy of what's going to be reported to the rating bureau is 12 to 15 months after the policy term ends. And there you want to make sure of two things. Is the payroll accurate, both by classification, assignment, and do we agree on the payroll, and are the claims reported accurate? And this is the information that you need to verify. So you want to make sure the report to the rating bureau made by the insurance provider is accurate. Premium development, it's after audit. It's not only the gross premium, the payroll by, it's also by classification. You want to make sure it's done. Then loss paid and reserved also by classification to make sure actually the worker who got injured is classified properly. And then you want to look at reserves are close to correct. You want to make sure that they are either closed or that they're close to correct. Are they accurately reserved? Don't worry about the reserve during the policy period for experience mod. Don't worry about the reserves even during the end of that policy period until the following term is up. Then you need to look at reserves. So if we think about that, we're now talking about 8 to 12 months after the injury has happened. By that time, the reserve should be relatively accurate. It should not be as much of a guesstimate. So you need to make sure the insurance carrier has all the facts to determine what those reserves are. And here's a misunderstanding. In experience mod development, dollars that hurt are the dollars that are paid. We've heard obviously severity versus frequency. And what happens here is that we talk about how that severity hurts worse than frequency. There is no way in the experience mod magnification or experience mod formulas where numbers of claims are counted. So if your insured reports a claim, unless something's paid on that claim, it does not affect it. The only thing that's accounted for is what is paid, not how many claims that happen. So pay, and when you look at what's paid, that will include also the dollars rent plus the reserves. So after the time of 6 months and no payments, the reserve should be reduced. If they're sitting there, even if it's reserved, and the worker has not been paid yet, unless you need to say, why is this still open? The worker is back to work. He has, there was no medical treatment. We just reported to you, why is it still open? So you want to check those things here and realize because I'm going to tell you in a minute, I want all claims reported. Don't let that be a problem. They should not hide those things. You want to try to keep the payment, though. This is how you can control your mod. The first dollars hurt the most, and it depends on the state. Once you pay over $7,500 or $10,000, anything paid over that is discounted. I've looked at a formula that was just sent to me by an outside firm, and I also looked at one, and I took a $100,000 claim. We had $100,000 paid in the policy. If it had been one worker with $100,000, the mod would have been 0.86. If it had been 10 claims at $10,000 each, again, same $100,000 paid, the mod would be 1.30 because of the discounting factors. And so this is also important. It's the smaller claims that cost the most. Once you pay more, then the dollars become less of a factor because they're discounted. And the indemnity, the loss of wages, hurts the most. So, suggestion in a minute, don't pay loss of wages. Have some means so your insured will keep paying the driver, paying the worker, so you don't have any payment made for their loss of wages. You can keep them on the payroll. As long as the insurance carrier does not make any payment for loss of wages, therefore the loss of wages, the indemnity payment are not reported under the statistical data furnished by the insurance carrier, then and only medical paid, then the medical is reduced by 85% in most cases. Again, you need to check each state very slightly, but it would be discounted here. That's if no indemnity is paid. But if $1 of indemnity is paid, then the payment goes into full value. So you need to understand it's not how many claims, but how much is paid. And the larger claims, dollars do not hurt as bad as the smaller dollars. That's where the frequency hurts worse than the severity. This is where this concept is. Then the indemnity hurts the most. So you want to try to keep wages here, and as long as no indemnity paid and medically only is paid, then they get discounted. So once an insured has had a bad mod, there is little they can do about it except write it out. The factors change each year. Current year and immediate past year are not included, but the following 3 years are. So it's a rolling calendar. We used to be able to get out bad mod by starting over again, but just like in auto liability with the chameleon carrier and the FMCSA now focusing on the people washing out bad past CSA history because of past experience by getting a new number, it doesn't work here either, because when you have a new entity, it's not based on the ownership anymore, it's based on the entity's past operation. And if it's the same operation, the same supervisors, the same exposure, then a mod carries over. This could be a concern later if you're insured on buying a motor carrier and the motor carrier has bad history in the mod. They're going to buy that old mod too, unless they have an established one already in their own name. So starting a new entity does not start over again. You've got to write it out. Claim handling. Control what's paid. If worker will be off for a short time, keep them on the payroll. What's a short time? A week or two? I wouldn't go much further than that, because then it doesn't pay, but to keep them on the payroll, either paid sick leave, per diem, or some matters like that. So it depends on the doctor's report. If they say you got a sprained knee, a twisted ankle, a broken arm, you're going to be off a week or two, then I would keep them on the payroll. If they're going to be longer than that, then let the work comp carrier. All the reports of claims you can show, will the driver or the worker still be paid or not. You need to address this with your carrier. Medical paid by the insured. The system used to set up, and I have been facilitating this in the past, for the insured to pay the medical. The smaller ones, the Band-Aids, maybe. But again, medical doesn't hurt you unless there's indemnity payment. So when I focus this, I want to talk to the insured not about saving money on the medical, more so saving money on not paying the worker for lost wages. Have the insured still do that. But if the insured determines to pay some of the small claims medical, what you've got to understand is the medical they're paying is medical for work comp. And therefore, when the doctor gets the bill, they would bill the work comp rate for the services, not what their normal fees are. And so that's something that you can help your insured with if they want to pay their own medical, to have the fee schedule for the medical bills, not what the doctor billed. So in claim handling, you want to control what's being paid. The indemnity payment is the one that hurts the most. And so you want to encourage your insurer to keep the workers on the payroll, again, for a short period of time, a week or two. This also helps the worker, because what happens is most of our workers work hand to mouth. If they lose a week pay, it's going to put them behind. Therefore, they encourage them to seek a lawyer, to milk it more. Because usually it takes, and a lot of times the first week is not even paid until they've been off 3 weeks. Even if the first week is paid after 3 days, the insurance carrier has 2 weeks to make the payment. So we have a worker now who has a small injury. They're going to be off for 2 or 3 days. They're going to be off for less than a couple weeks, yet they get no pay during that period of time. Simply because of the system. That's how the system works. Keep them happy. Keep them on the payroll. If they're a good worker and we want them back, you need to develop a means to help the insured to keep them on the payroll for that period of time. If the insured pays their own medical, again, you have to talk to the insured. You have to show the benefit to the insured for doing it. You have to talk to the work comp carrier to make sure they understand that the insured is doing these things in this area, because But then if they do that, you've got to understand that they do not owe what the doctor bills. They owe what the fee schedule for work comp would pay. You've got to make sure the insured reports all claims. Anytime a worker or driver says, I think I'm hurt, I think I twisted my knee, I think I twerked my back, I slipped on this stuff, you want to report it. You want to address it. Reporting the claim does not hurt your experience mod. It's what's paid. But by not reporting the claim, alerting the insurance carrier up front can cause problems later. You must offer medical treatment and see the worker goes to the treatment. You got to get the report of the treatment. You want to make sure that during that early time that the treatment's there. You don't want to wait until something happens. You slow down, season's over, you put them, you take the driver off, you replace the driver. Oh, you remember when I slipped 3 months ago? My back hurts now. Without immediate medical treatment, you don't know what happened there. The thing that I have found handling work comp, the number one consideration is what happened the day of the claim, and the medical treatment's there. You'll control who provides treatment. You want to have set up a series list. The employee has an option to go to other places, but if you send them direct to your own, most of them won't shop that. You want to make sure the follow-up treatment, the employee goes to that follow-up treatment for the therapy, to check take the stitches out, to do those kind of things. You want to find that. Then get the worker back to work as soon as possible. Control the payment for lost time, sick leave, or loans. Provide controlled modified duty. Sometimes we call this light duty, but I like the term modified duty because I don't know what light duty is. Bring them back. A lot of times in trucking that's hard to do because most of the time all your insured has is a driver position, and they might not be able to get in and out of a cab. They might have a broken foot. But there's other things they can do around the yard. Bring them back as soon as possible. The point here is pay what the job's worth so that they have an encouragement to get back to their own pay by going to the doctor and getting a full duty release, MMI. Then you can put them back to their old job duty. All drivers' activities do not expose the driver to the same exposure. Now, obviously, when driving down the highway, their past activities could tell you if they have a potential crash or not. You had the MVRs, you had the pre-employment screening program to see if they had previous crashes, or you look at the CSA scores that they have developed for you or other motor carriers in those situations. Do they have components for crashes? Other than driving, does the driver load and unload? And if so, is it by hand or by equipment? If it's a flatbed, do they have to adjust the tarp? If it's a dump truck operator, do they have to make sure getting on top of the dump truck to tarp it? Not only that, to shift the load around so that the weight distribution is right. So each risk has a different here. I had a friend of mine who I first started this that said, I want to write the best class of classification, meaning that all roofers have the same rate. The one I want to write is the roofer that is single-story flat roof, not the high-rise, the same rate. So the drop and hook has very little exposure beyond driving. Flatbed, low boys, and tankers have a lot of loading and unloading where the driver has to get on the trailer, have to tie down the trailer, have to do tarps, chains, binders. Tankers, they have to pull the hoses out and deliver. Major difference there. Also, what's the length of the trip? For every driving 11 hours or working 14, they have to stop for 10 hours. Where they stop for that 10 hours, that is a 24-hour, 24/7 exposure. Whatever they do during that rest period would be job-related and compensable. If claim is made, then it's questionable. Report anyway and let the carrier know it's questionable. Do medical records and treatment by the medical provider notes match the worker and saying what happened to him? That's the problem we have here. In a factory or an office, we can see what happened immediately. But we got drivers all over the country. We got drivers all over the area. We don't know. Yes, big crashes, truck gets damaged, but not tripping and falling at the truck stop, not falling off the flatbed. Did they twist their knee during the 34-hour restart playing basketball, or did they twist their knee jumping off the trailer when they tied it down? That's what you got to factor in. The insured might disagree with, but the treating physician provider information is the deciding factor. So you got to report it, even though you don't agree with what happened. If there's a dispute in this, then let the work comp carrier know you question it, and then you got to go back to the medical treatment and to find out what they say that happened based on what the driver said, and did the injury happened based on what the driver said. Could that have caused the injury that the driver is complaining? Conclusion. Make sure you set the policy up right. Make sure you have the states where they have operations in 3A, particularly the states the driver lives in. 3Cs, you want the rest of the country starring states. So you want every state can be different, so you need to have those listed there. Premium. What's payroll? Do you have per diem set out? What state payroll is allocated to? And clear that up front. You don't want to have if any. You don't want to have that. You want to clear up the classification up front. Concern owner-operators. Make sure all states' work comp carriers insurers agree on what the problems owner-operators and how they're classified. Not covered by work comp, they're independent contractor. Make sure the audit exposure has not generated additional dollars and your insurance carrier agrees with that. At claim time, again, big difference between being able to claim under work comp, the additional claim over tort. Again, it's their option, not yours. You want to have contracts drawn up to spell this out. You don't want 2 or 3 page contracts. The contracts need to be 7 or 8 pages long, and you need to monitor these things. This is the last of the 4 hours for the work comp. We hope you benefited from this to make you a better insured, make you a better, more useful to your insureds. Thank you very much for your time and considerations.